Good afternoon. My name is David Jarvis, and I'm President, CEO, and founder of Corton Capital. Corton Capital is an asset management firm that specializes in traditional investments and alternative investments. Our goal is to create comprehensive portfolios for investors by marrying up both traditional and alternative investments for you. What follows next are a series of presentations and comments by various managers within the Corton family discussing the performance and successes that they've experienced with the funds that are carried within the Corton family. I hope you find it informative and we look forward to working with you. We are here to work with you and create comprehensive and interesting portfolios for you. Thank you very much.
Hi, everyone. This is Omar Khan from Theta IQ, a part of Corton Capital. And today I'm going to talk about a few things. I'm going to talk about what we do differently, the macroeconomic outlook of what's going on right now. And I'm going to give you a little bit of a hint. It is the word inflation, but let's get into it. Let's see exactly what's going on and let's look at how we can do this. So a little bit about my background. I spent 25 years in finance, mainly, and I've been trading options and investing for 25 years. And so myself and my business partner, we decided to work with David to launch the Theta IQ Alpha portfolio. Now that's a portfolio that's focused mainly around companies that are invested in artificial intelligence. We believe this is a once in a lifetime opportunity that probably will not come our way again anytime soon. Now that being said, we have had opportunities in the past, but nothing like this. This is something that's very different. And that's something we want to really take advantage of and get our clients behind. So let's take a look at the macroeconomic outlook, okay? So what exactly is going on? Well, the reality is the economy is slowing, both in Canada and the United States. So first quarter, U.S. economy showed a lot of volatility with Q1 GDP at negative 0.2%, and then Q2 at 3.3% positive. Now, a recession is defined as 2 negative consecutive quarters. So although we didn't get that technical recession, you can still feel it. It's not great. And what's the reason behind that? Well, the reason is mainly these imposed tariffs, okay? So the tariffs, what they do is when you're importing goods, like some goods you have no choice but to import. Like let's take avocados from Mexico as just a simple example. You have no choice. You have to import them. You can't make them domestically. And if all of a sudden they are subject to a tariff, that means it causes the consumer to pay more money for that good, in this case, avocados, right? So inflation remains a little bit higher than the Federal Reserve would like. At the same time, the economy is slowing or is slowed down substantially because when you have tariffs, you have uncertainty, companies aren't hiring, consumers aren't spending, you have a bit of a problem on your hands. And also another factor is you cannot lower interest rates. Lowering interest rates spurs on the housing market. That creates a lot of economic activity. So it's not the best of any world, but that's exactly the position we're in right now. So hopefully we get beyond these tariffs pretty quickly and we're able to cut interest rates a little bit here in September and in the latter half of the year, which will be a bit of a boost to the economy. Now, the labor market is showing signs of cooling, right? Unemployment rate in the United States has gone from 4 to 4.3%, and the latest non-farm payroll reports have come in significantly below forecasts. The last one actually came in at 22,000 jobs. Only 22,000 jobs created for an economy the size of the United States is almost a rounding error. It doesn't mean much, okay? This indicates hiring is slowing along with higher inflation, so demand for goods and services likely to weaken, which may lead to further unemployment. Again, this can all be alleviated once tariffs are gone or curtailed, but we don't know when that's going to happen. And also, again, like I said, the uncertainty behind it is another issue. If you don't know if tariff is going to be implemented, if you're a company, are you going to be looking to hire people? Are you going to be looking to grow your business not knowing whether there's a tariff in place, not in place? You don't know. So that uncertainty creates an additional dimension. Now, the silver lining behind this is the recession fears are mounting, and there is a call for an interest rate cut coming up in September. It's probably going to be 25 basis points or 0.25%. It could even be 50 basis points. Okay. Now, the Trump administration has been leaning on the Federal Reserve to cut interest rates. Now, traditionally, there's supposed to be a separation between the presidency and the Federal Reserve. But this time it's kind of it's a bit more blurry. But let's see if rates are cut. Now rates, again, like I said, almost certain guarantee it's going to be cut 25 basis points, maybe up to 50 basis points. This could help out the markets, okay? 8.2% probability of 50 basis point cut and 91.8 probability of a 25 basis point cut. Now, what do we do here differently at Theta, and why do we do it? Well, almost all funds over a longer time, 10 years, don't perform as well as their benchmark. So what does that mean? That means you're better off as an investor, as a consumer, just buying the index itself, right? And the main reason is, you can see the numbers here, over a 10-year period, in every category, the percentage of actively managed funds that underperform their benchmarks. This is a huge number. It's anywhere from, like, call it almost 80% to almost 100%. So what value are you able to add? So how are we able to add? And I would say the main culprit behind this is, if you look exactly like the market or very similar to the market, you're going to perform very similar to the market. And if you perform very similar to the market and you minus the fees, therefore you have your underperformance. So the S&P 500 has 500 companies in it. Okay. Now on the right-hand side, if you hold 200 or over 200 companies, or 80 or 70 or whatever it is, you're going to look very similar to the market. And again, like I said, after you minus your management fees, there's a high likelihood that you don't do as well as the simple index would have done. Now on the right-hand side, you can see some funds with smaller holdings, but we prefer to go even smaller than that. Now, we only hold about 10 to 12 companies. I'm going to get into that a little bit more. But one of the a position we hold also is designed to take advantage of what we believe is the inflationary aspect. So in most societies, not only are you taxed as an individual, the government goes ahead and prints money, and them printing money creates less value for existing money. So we've also invested in Bitcoin through the IBIT ETF, BlackRock IBIT ETF. And the main reason is the S&P 500, if you look at purchasing power, and this is going back about 30 years, it's declined 52.82%. Now the S&P has increased 961%. That's great, and that's fantastic. But for those people who are not able to purchase stock, well, they've got a big issue on their hands. And this is why you continually see a divide between wealthy and non-wealthy. If you own stocks, you own real estate, you take advantage of this inflationary aspect. If you don't, your hourly wage that you earn hasn't increased as much in the last 30 years as inflation has an impact. And that's why you continue to see this divide. So we have invested heavily in Bitcoin through the IBIT ETF. Now, what makes this different? Well, a few things. First of all, we own concentrated portfolios. Like I said, 10 to 12 positions. That's it. We don't hold 30 or 70 or 200 positions, because if you resemble the market, more than likely you'll perform like the market. And then after you minus your management fees, you're not going to do as well. Second thing is, we sell options to enter positions. Now, I don't want to get too much into it. It's a bit of a convoluted idea. But the idea is simple. We agree to buy stocks that we want to buy for a discount, and we get paid very nicely for it. The worst thing that's going to happen to us is we're going to own a stock we like. The last thing that we take into account is seasonality. Now, the stock market, I don't know if you've ever heard the saying, but the stock market has a saying, sell in May and go away. Well, the stock market performs really well from the end of October to the beginning of May. And from the beginning of May to the end of October, it doesn't do as well. It's more flattish, okay? So we definitely take this into account. Now, if you look at diversification, how many stocks do you actually need to be diversified? And the reality is, you need about 15. Not 100, not 80, not 200, not 400, as the typical funds in Canada hold. We hold, like I said, 10 to 12, and it will always be that way. So we will always be concentrated. Now, the advantage of that is you can research your companies very thoroughly, and then you take a very calculated decision on how much you want to hold of that company. So if your companies do what you think they're going to do, you have a greater likelihood of beating the index. That is exactly what we're looking to do. Okay. Now let's take a look at the Magnificent Seven, and these are the companies that are going to benefit and have benefited so far from artificial intelligence. Okay. It represents over 32% of the S&P 500, and it significantly outperformed the index. And we think the next number of years, this could even increase further with artificial intelligence becoming a more and more part of our lives and changing our lives in ways that we didn't even imagine. Okay, so we are invested mainly in these Magnificent Seven companies to take advantage of the artificial intelligence revolution, which is currently upon us. Okay, now you look at how quickly technologies are actually adopted. And this is going back to the early 1900s. You can see the phone, electricity, radio, etc. Now where are we? Well, we can see smartphones here, tablets. But one of the things that we really want to take advantage of is Bitcoin, because we believe that governments around the world will continue to print money. They will continue to erode the value of current money. Imagine you had a printer in your home, and if you were in a little bit of debt or you spent more than you should have, you could just print some more money. That's what the government can do. And when they do that, they make the value of existing money worth less. Now, what does Bitcoin do? Bitcoin is an excellent hedge against that. Bitcoin has a limited supply ever of 21 million. There will never be any more. So if you want to own a hedge against all this money printing, and you want a great store of value that you can transfer anywhere around the world without having to physically carry it, like even gold right now, you have to physically carry it. And also the supply of gold increases 3 to 4% a year. So this is one of our main holdings, and we really wanted to point this out. I want you to take a look at the best performing asset categories over the last 15 years. And the second column, the second row, sorry, is the QQQ, NASDAQ 100. If you look all the way to the right, 2011 to 2025 annualized, you'll see a compounded annual return of 18.4%. That's fantastic. Now, if you apply something called the rule of 72, you take 72 divided by 18, that will give you how long it takes to double your money. 72 divided by 18 is roughly 4. That means had you invested in NASDAQ in the last 15 years, your money would be doubling every 4 years. Now, this could be different over the next number of years with artificial intelligence. We believe that we have the chance to have this number even higher because of how much of an impact artificial intelligence is going to have on our lives. So that is why we are invested in these companies, and we are concentrated. Okay. Now, our holdings are companies you've heard of. They're the biggest and the best companies in the world. Microsoft, Tesla, NVIDIA. Now, Eli Lilly is one company that doesn't really fall into this artificial intelligence realm, but it is a diversifier for us, and we do believe that things will escalate substantially on the biotech front because, again, of artificial intelligence. Now, we have Amazon, Alphabet, which is Google, Meta, Advanced Micro Devices, Bitcoin through IBIT ETF, Taiwan Semiconductor, Apple, and the last holding we have is Constellation Energy. Why Constellation Energy? Because the amount of processing power, the amount of energy it's going to require to fulfill not only artificial intelligence, but things like electric cars is going to increase substantially. The world is going to need more energy. Constellation Energy is really well positioned to provide that energy in the future. So these are the companies we're invested in. And we believe that this is literally a once-in-a-lifetime opportunity to take advantage of being invested in artificial intelligence. Now, you talk to friends and family and whatnot, and more people are using things like ChatGPT on a daily basis. Now, if you extrapolate that out a little while, a year, 2 years, 3 years, 5 years, imagine how much more that could be. Well, who are the companies that are going to benefit from that? These are the companies that are going to benefit from it. It will require amounts of energy. The government will continue to print money. So these are the companies we hold. We sell options on them, and we look at seasonality to decide how aggressive we want to be or not be. Now, this is what differentiates us. We do all of our research in-house. We use the products and services that we invest in. And to give you an example of that, for example, if you invest in Tesla, well, do you own a Tesla? Do you drive it every day? Do you use the full self-driving software? That is one example. If you do, you have a much more intimate understanding of its impact on the company and society as a whole. And that's exactly what we do. So we invest in innovative companies that are invested in artificial intelligence. We incorporate concentration, option, seasonality. We manage risk, meaning we do not invest with more money than we have. There is no leverage in this portfolio. So if there's $1,000 in the portfolio, we don't invest more than $1,000. We have a small minimum investment because we want people to get to know us, even if they put a small investment in, and they can see what sort of results we can generate. And at that time, hopefully they'll invest more. And then we also have a monthly call where we go over the details of what the portfolio did, what the performance was like, and where we see the future. This, again, is very different than what you would get at a traditional institution like a bank. They don't really inform you. You don't know what's going on. You walk into your advisor's office once a year. They'll tell you what your return is, and that's kind of it. But we are committed to keeping you educated, informed about what's going on so that your level of comfort is high. So when the market pulls back, and inevitably always does, even though it has averaged 18.4% for the last 15 years, you do have pullbacks. And 2022 being a more recent one. But when you have this pullback, it's much more easy to be confident in your decision making when you understand what is going on. So we're committed to that as well, okay? Quarton Capital is launching a new product specifically for disabled people called the Quarton Capital Registered Disability Savings Plan. Here to provide more information about the plan is Brenda Catan. Over to you, Brenda.
Thank you. I'm Brenda Catan, manager of the RDSP investment program at Quarton Capital, and I've been working to get disability benefits for Canadians for over a decade. Do you or someone in your family have a disability? Quarton Capital can help. We specialize in the Registered Disability Savings Plan and can help you open an RDSP if you're eligible for the disability tax credit, are 59 years of age or younger, have a social insurance number, and are a Canadian resident. Most financial institutions leave the guesswork to you and offer completely self-directed RDSPs. Our comprehensive RDSP management program takes care of everything, from setting up your account to maximizing government entitlements, comprehensive portfolio management, and strategic contribution planning. We'll also help you receive up to $90,000 in entitlements from the government. Secure your financial future today. Visit us at rdsp.quartoncapital.ca or call us at 1-888-334-0033 to get started.
If you want to get a hold of myself, Omar Khan, here are my credentials. There's my phone number, my email address, my business partner, Matthew Todman, and also, of course, David Jarvis. He's a portfolio manager at Quarton Capital. Please get a hold of any of us whenever you feel like. We'd be more than happy to talk to you. And I appreciate your time. Obviously, read the disclosure at your leisure, whenever you feel like. Okay. And thank you so much for your time. And we look forward to speaking with you soon. Take care.